What if I told you that one of the smartest long-term investments isn't Bitcoin, gold, or the stock market, but a piece of farmland? It may sound surprising, but while millions of investors chase the latest financial trends, some of the world's wealthiest individuals are quietly buying agricultural land. Welcome to Finant History, where we uncover the stories behind the world's greatest investments and financial decisions. The reason is simple. Every person needs food, and every meal begins with productive farmland. Unlike many investments that depend on market sentiment, the demand for food never disappears. At the same time, quality farmland is becoming more limited due to urban expansion, climate change, and shrinking natural resources. When demand keeps growing while supply remains limited, valuable assets often become even more valuable. A great real-world example is Iowa, one of America's top farming states. Over the past 2 decades, many farmland owners have earned steady rental income by leasing their land to farmers, while also benefiting from the long-term appreciation of farmland values. This combination of passive income and asset growth has made farmland an attractive investment for patient investors. So if farmland has quietly created wealth for generations, why are so many people only beginning to notice its true value today? Why are some of the world's richest people buying farmland instead of putting all their money into stocks or luxury real estate? The answer is simple. They look for assets that create value over the long term. Farmland isn't just land, it's a productive asset that helps feed the world. As long as people need food, productive farmland will continue to have real economic value. It can also generate passive rental income when leased to farmers, while the land itself may appreciate over time. A great real-world example is Bill Gates, who owns more than 270,000 acres of farmland across the United States, making him one of the country's largest private farmland owners. Although his investment strategy is unique, it highlights an important lesson. Many experienced investors prefer productive assets that can generate long-term value instead of relying only on short-term market movements. They think about preserving wealth for future generations, not just maximizing returns this year. This raises an interesting question. If some of the world's most successful investors see long-term value in farmland, what exactly makes this asset capable of generating passive income year after year? That answer reveals why farmland is different from many traditional investments.
What makes farmland different from most other investments? The answer is that it can generate income without requiring you to farm the land yourself. Many investors simply purchase productive farmland and lease it to experienced farmers. The farmers grow crops such as corn, wheat, or soybeans and pay rent to the landowner through an annual or multi-year lease. This allows the owner to earn passive income while also benefiting from any long-term increase in the land's value. Instead of relying on a single source of return, farmland can provide both regular cash flow and capital appreciation. A great real-world example comes from Illinois, one of the largest farming states in the United States. Many farmland owners, including retirees and investment groups, lease their land to local farmers instead of farming it themselves. The farmers continue producing crops while the landowners receive steady rental income each year. Over time, many of these properties have also increased in value, giving investors 2 potential sources of return from a single asset. This is one of the biggest reasons farmland has attracted patient investors for decades. The real opportunity isn't just owning land, it's owning an asset that has the potential to produce value year after year.
Do you need hundreds of thousands of dollars to invest in farmland? Not necessarily. While buying farmland directly is the traditional approach, it's no longer the only option. Today, investors can choose from several methods depending on their budget and financial goals. Some people purchase farmland and lease it to farmers for passive rental income. Others invest through farmland REITs, which own and manage agricultural properties, allowing shareholders to benefit without owning a farm themselves. There are also fractional investment platforms that let multiple investors own a share of farmland, making agricultural investing more accessible than ever. A great real-world example is Gladstone Land Corporation, one of the largest publicly traded farmland REITs in the United States. The company owns farms across multiple states and leases them to experienced farmers who grow crops such as berries, almonds, pistachios, and vegetables. Instead of buying an entire farm, investors can purchase shares in the company and gain exposure to farmland while avoiding the responsibilities of managing agricultural property. The important lesson is that farmland investing isn't limited to billionaires or large farming families anymore. Today, there are opportunities for investors with different budgets, but choosing the right investment method is just as important as choosing the right farmland.
Farmland has built wealth for many investors, but that doesn't mean every piece of land is a good investment. Like stocks, real estate, or any other asset, farmland comes with risks that every investor should understand. Weather conditions such as droughts, floods, and storms can reduce crop production. Water availability, soil quality, changing commodity prices, government regulations, and property taxes can also affect a farm's profitability. That's why experienced investors spend more time researching the land than negotiating the price. A great real-world example is California's drought from 2012 to 2016. During those years, many farmers struggled because of severe water shortages, forcing some to reduce production or leave parts of their land unused. However, farms with secure water rights and efficient irrigation systems continued operating much more successfully. This showed that access to water can be just as valuable as the land itself, and that two similar-looking farms can produce very different investment results. The biggest lesson is simple: never buy farmland based on price alone. The most successful investors focus on land quality, water security, and long-term productivity, because those factors often determine whether an investment creates lasting wealth or becomes an expensive mistake. If you were choosing between two farms with the same price, how would you know which one is the better investment? Smart investors don't look at size alone. They look at quality. The first thing they evaluate is soil fertility, because healthy soil can produce better crops and attract reliable tenants. They also examine water availability, climate, road access, irrigation systems, and the local farming economy. A farm located in a productive agricultural region with strong infrastructure is often a better long-term investment than a cheaper property in a less productive area. A great real-world example is Nebraska, one of America's leading agricultural states. Known for its fertile soil and reliable irrigation from the Ogallala Aquifer, Nebraska has remained one of the country's strongest farmland markets for decades. Many investors who purchased productive farmland in the state benefited from steady rental demand and long-term appreciation because the land consistently supported profitable farming operations. Their success wasn't based on luck. It was based on choosing quality over price. The lesson is clear. The best farmland investment isn't always the biggest or the cheapest. It's the one with the strongest long-term potential. Careful research today can make the difference between an average investment and one that creates wealth for decades. Is there really a perfect time to invest in farmland? Many people wait for prices to fall or try to predict the next market cycle, but successful investors often follow a different strategy. Instead of trying to buy at the perfect moment, they focus on purchasing high-quality farmland and holding it for the long term. The value of farmland may fluctuate with interest rates, crop prices, and economic conditions, but the long-term demand for food has remained one of the strongest drivers of its value. A great real-world example is the 2008 global financial crisis. While stock markets around the world suffered major losses and investors panicked, productive farmland in many parts of the United States remained relatively resilient. Investors who purchased quality farmland during that period and held it for several years often benefited as land values recovered and continued to grow. Their success wasn't the result of perfect market timing. It came from recognizing the long-term value of a productive asset and staying patient. The biggest lesson is this: building wealth is usually about time in the market, not timing the market. When you invest in high-quality assets with a long-term mindset,
patience often becomes one of your most valuable advantages.
If you had $100,000 to invest today, would you choose stocks, real estate, gold, or farmland? Each investment has its own strengths, but farmland offers a unique combination of benefits. Stocks can deliver strong returns, but are often volatile. Gold is considered a safe haven asset, yet it doesn't generate income. Rental real estate can provide cash flow, but it also requires maintenance and property management. Farmland is different because it can produce passive rental income while also benefiting from the world's constant demand for food. That combination makes it an attractive option for many long-term investors. A great real-world example is the 1970s inflation era in the United States. As inflation reduced the value of cash, many productive farmland properties appreciated significantly because agricultural products became more valuable and food demand remained strong. Investors who owned quality farmland not only preserved their purchasing power, but also benefited from rising land values and farm income. This is one reason farmland is often viewed as a potential hedge against inflation. The key takeaway is that no single investment is perfect for every situation. However, farmland has earned its place alongside stocks, gold, and real estate because it combines real economic value, income potential, and long-term stability in a way that few other assets can.
What's the biggest mistake new farmland investors make? Surprisingly, it's not choosing the wrong crop. It's buying land without doing enough research. Many beginners focus only on finding the cheapest property, believing all farmland will eventually become valuable. But factors like soil quality, water availability, road access, local farming activity, and zoning regulations can make a huge difference in an investment's long-term performance. A low purchase price doesn't always mean a good investment. A great real-world example comes from Arizona, where some investors bought inexpensive farmland expecting rapid appreciation. However, several of those properties faced water shortages and irrigation challenges, making farming more difficult and reducing their long-term value. Meanwhile, nearby farms with secure water rights continued producing crops successfully and remained in strong demand. The difference wasn't the purchase price, it was the quality of the land and the research completed before investing. The lesson is simple. The cheapest farmland is rarely the best investment. Smart investors don't just ask how much does it cost. They ask, will this land still create value 20 years from now? That single question can make all the difference.
What will make farmland even more valuable in the future? The answer lies in one simple fact. The world needs more food every year, but it isn't creating more productive land. As the global population grows and cities continue to expand, high-quality farmland is becoming an increasingly limited resource. At the same time, modern technologies like AI-powered farming, drones, precision irrigation, and GPS-guided equipment are helping farmers produce more food from the land they already have. This combination of rising demand and limited supply is one reason many investors remain optimistic about farmland's long-term future. A great real-world example is Brazil's Mato Grosso region. Over the past few decades, advances in farming technology, better infrastructure, and increasing global demand for soybeans and corn have transformed the region into one of the world's most productive agricultural areas. As agricultural output increased, productive farmland in many parts of the region became significantly more valuable, demonstrating how innovation and food demand can work together to strengthen long-term investment potential. The future of farmland isn't based on short-term market trends. It's driven by one of the world's most essential needs. For investors who think decades ahead rather than months ahead, that's a trend worth paying attention to.
After looking at the opportunities, risks, and future of farmland, one lesson stands above everything else. The greatest investments are often the ones that solve real human needs. Markets rise and fall, technology changes, and new investment trends appear every year. But people will always need food. That's why productive farmland has remained valuable for generations. The world's most successful investors don't simply chase the newest opportunity. They focus on assets that can continue creating value for decades. A powerful real-world example is the Church of Jesus Christ of Latter-day Saints, which has quietly accumulated large amounts of productive farmland across the United States over many decades. Rather than treating farmland as a short-term investment, the organization has viewed agricultural land as a long-term strategic asset, capable of producing value and supporting future needs. Whether or not someone follows the same strategy, it demonstrates an important investing principle. Assets that produce something the world will always need often remain valuable through changing economic cycles. The biggest takeaway is this: lasting wealth is rarely built through excitement. It is built through patience, discipline, and ownership of productive assets. Farmland reminds us that the best investments are often the ones quietly creating value, while everyone else is chasing the next big trend.
What's the biggest mistake new farmland investors make? Surprisingly, it's not choosing the wrong crop. It's buying land without doing enough research. Many beginners focus only on finding the cheapest property, believing all farmland will eventually become valuable. But factors like soil quality, water availability, road access, local farming activity, and zoning regulations can make a huge difference in an investment's long-term performance. A low purchase price doesn't always mean a good investment. A great real-world example comes from Arizona, where some investors bought inexpensive farmland expecting rapid appreciation. However, several of those properties faced water shortages and irrigation challenges, making farming more difficult and reducing their long-term value. Meanwhile, nearby farms with secure water rights continued producing crops successfully and remained in strong demand. The difference wasn't the purchase price, it was the quality of the land and the research completed before investing. The lesson is simple: the cheapest farmland is rarely the best investment. Smart investors don't just ask, how much does it cost? They ask, will this land still create value 20 years from now? That single question can make all the difference.
So, after exploring the history, opportunities, risks, and future of farmland, one conclusion becomes clear. Farmland isn't a get-rich-quick investment. It's a get-rich-slow, stay-rich-longer investment. It rewards patience rather than speculation. While no investment is completely risk-free, productive farmland has remained valuable for generations because it supports one of the world's most essential industries: food production. As populations continue to grow and quality farmland becomes increasingly scarce, its long-term importance is unlikely to disappear. A powerful real-world example is the University of Illinois Foundation, which has included agricultural land as part of its long-term investment strategy. Like many large institutions, its objective isn't to chase short-term market gains, but to own productive assets that can preserve wealth and generate value over decades. This approach reflects the mindset of many successful long-term investors. Focus on assets that continue serving real human needs. If there's one lesson to remember from this documentary, it's this: the smartest investors don't chase every new trend. They build wealth by owning assets with lasting value. Whether you invest in farmland, stocks, real estate, or another asset, always think beyond today's headlines and focus on the next 20 or 30 years. If you enjoyed this video, please like, subscribe to Finant History, and turn on notifications for more documentaries on investing, financial history, and wealth building. And before you go, tell us in the comments, if you had $100,000 to invest today, would you choose farmland, stocks, gold, or real estate, and why? Thank you for watching Finant History. Until